The second Sunday in a row that the Federal Reserve felt compelled to make an announcement to the public to reassure everyone they're doing something. Don't need to know what it is, but they're doing something and they're making a big deal out of it, especially this one. This one happens to be global. Whereas last Sunday they were talking about Silicon Valley Bank, Signature, regional US Bank, something about funding and depositors there, a brand new four-letter program called the BTFP. This Sunday sounded more global than national because it was again these central bank liquidity swaps or overseas dollar swaps. And I know what you're thinking. You're thinking, wait a minute, haven't these dollar swaps been around for basically 15, almost 16 years now? And the answer is yes. These dollar swaps go all the way back to December 2007, and they have been used in repeated fashion during times like this, and the Fed continues to make different announcements about them because they keep changing the terms. Way back when, they started with a very fixed allotment, small allotment, very few central bank counterparties, and decided that wasn't working, so they raised the allotment, added a few more central bank counterparties. That didn't seem to work. So then they went to, instead of a fixed allotment, made it a full-on auction where unlimited amounts at whatever price, but the price was set by the Fed, and the Fed was OIS plus 100, then it was OIS plus 50, and lately it's OIS plus 25. So over the last 15 years of these dollar swaps, the Federal Reserve continues to change the terms, which kind of tells you they don't seem to be working in the way the Fed would like. Because if they were the liquidity backstop that everyone says they were, they would just need to have them open at a standard rate and just let everybody come in. They would work as a backstop. Everybody would go home. The whole system would be fine. The world would be great and the economy would be flourishing. And no, I guess I said, second Sunday in a row, the Federal Reserve has felt compelled to do something. Now, what did they do this past Sunday, March 19th? Well, here's from the press release. It got together with its five closest friends, the five usual suspects, the six of them together. We got the Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank, the Federal Reserve, and the Swiss National Bank. Keep that one in mind. Announcing today a coordinated action to enhance the provision of liquidity via the standing US dollar liquidity swap line arrangements. Again, this still is a surprise to people even to this day. Global US dollars, euro dollar problem. If we're talking about dollar swaps, we're talking about the Fed trying to get dollars out there into the foreign hinterlands. This is euro dollar. What does that have to do with Silicon Valley Bank, you're asking? Not a whole lot directly. So already we're getting confirmation of what we've been saying for a very long time. Dollar problem globally. That's what's been in curves more than Silicon Valley Bank and problems at U.S. regional banks. Back to the press release. To improve the swap line's effectiveness, because why do we need to improve them? In providing U.S. dollar funding globally, the central banks currently offering U.S. dollar operations have agreed to increase the frequency of 7-day maturity operations from weekly to daily. These daily operations will commence Monday, March 20th, that's today, and will continue at least through the end of April. So here we have the latest change to improve the effectiveness of these dollar swaps, because they're not at all effective. So now we have, instead of weekly auctions like we talked about importantly last October in Switzerland, now we're going to do these 7-day term auctions every single day, which kind of sounds like you're worried about something more substantial than a whole big nothing. That's always the natural tension with central banks, and we'll get into that, to reason why they're doing what they're doing today, as well as what this might really be about. And it starts with Switzerland, or maybe a bank name that you've heard recently, Credit Suisse, but it does not end there. Of course it doesn't end there. We wouldn't have these Sunday announcements seemingly every Sunday now. Maybe that's going to be a regular part of our weekly calendar. Let's hope not. But first, I'm Jeff. This is Eurodollar University. Thank you very much for joining me. I really appreciate it, especially at times like this where I hope I can at least help people make sense of what's going on behind the scenes in the shadows, which is what Eurodollar University has really been. That's what it's for. That's what I invented it for. That's what I meant to do all along. And to help you, we've got research subscriptions where you keep up on what's going on with every day, the daily briefing, major macroeconomic stuff, major moves and curves of markets, a deep dive analysis where we focus on going deep into these topics to really understand what they're telling us. And I do have Eurodollar University memberships to go over the background, the educational stuff. How did we get this way? What is money? What is banks? What are all of these things that we're talking about? Securities lending, collateral, repo, Eurodollar.University. So what is the purpose? These dollar swaps, they keep changing the terms all the time. As I said, they started out with fixed allotments. Then they went to unlimited allotments, but changed the price. Then they made the price different. As you said, they lowered it from OAS plus 100. Now it's OAS plus 25. I mean, now we're doing it from weekly auctions, which were, hey, that's much better, to now we got to improve the effectiveness to daily. I mean, you really do get the sense that the auctions themselves don't really do much. There's really something else going on here. And if we go back to May 6th of 2010, they kind of spilled the beans a little bit. The FOMC discussion, May 6th of 2010, that was just around the time of the flash crash, the European sovereign debt crisis, Greece, all that stuff. That wasn't really about Greece, and it wasn't really about the flash crash on Wall Street. It was about repo. There was problems in collateral in particular that was having spillover effects globally in US dollars because European banks were finding themselves in all sorts of collateral issues. So the Fed said, well, we've got these dollar swaps. Should we get them restarted again, even though it's only a couple months after we stopped having them at the time? They've since been made permanent since 2013. But at the time, they said, let's start these dollar swaps. So in May of 2010, let's go to the FOMC. Here's Ben Bernanke basically telling you his point here. Chairman Bernanke, moreover, everybody I've talked to about this in the central banking world thinks that at least as important as the direct effect on the dollar funding problems would be the psychological effects of an international coordinated effort in size that supplements the main actions. Of course, we've just said the dollar swap, the direct effects from the dollar swaps themselves, not a whole lot there. History has shown that time and time again. Just like the discount window, when there's a lot of action at the Fed's dollar swaps, the dollar swaps don't help. They do for individual firms, but systemically, they don't stem the tide of the systemic problem that's going on. They're basically there when everybody uses them. That's how you know things are bad. So what they're really talking about here, as he said, the psychological effects of an international coordinated effort. What did the Fed just do yesterday on Sunday? They announced an international coordinated effort. Now, what change did they make in these dollar swaps? Doesn't matter. They got to change something so that it sounds like they're doing something. But their purpose of doing something is to tell the public they're doing something and hoping that the public takes away from that happy feelings and positive emotion. Oh, the Fed's I have no idea what these dollar swaps are. I have no idea what the difference between a weekly and a daily auction is. So it sounds like the Fed is doing something substantial. And by the way, they're doing it substantial with these 5 major central banks all over the world. It really sounds like I need to stop being nervous and just start spending freely and investing freely and doing risky things like I want to do or like the Fed wants me to do. It's all about what they call an announcement effect. They're attempting to use these announcements like the BTFP last Sunday to calm the markets, to soothe a bunch of nerves. And the fact that we're still talking about this, we're still talking about shares plummeting for First Republic Bank, among others, tells you all you need to know about the effectiveness of either these programs directly or the stupid psychological effect. Again, as I keep saying, these are not central banks. They're pop psychologists. So the announcement effect is intended to do what? Last Sunday, the BTFP was intended to soothe the nerves of U.S. depositors, especially uninsured depositors. This has nothing to do with uninsured depositors in the U.S. This has everything to do with, once again, European banks, more than any. Not just European banks, but we're going to start with European banks. One in particular, the one that you've been hearing about constantly for not just the last couple of weeks, but for months. And there's a reason for it. It's probably not the one that you're thinking of or the one that you've heard about. I'm talking about Credit Suisse, the big Swiss bank, which is now part of UBS. Suddenly, like Bear Stearns way back when, the two have been combined, and everybody's supposed to celebrate this combination as the successful conclusion of a troubled but yet brief and ultimately no big deal type of situation. And we know that's not the case because, as I've talked about many times before and will again, the lessons of Bear Stearns are being learned and acted on right now as they were in Credit Suisse all this time. I'm going to go to the Credit Suisse numbers because there's a set of them in particular that really exemplifies my point. My point here, again, going back to the Fed's dollar swaps, is global dollar shortage. The global dollar shortage refers to, first of all, dollars are not physical Federal Reserve notes or cash or gold bullion. They're actually book entries. And they're book entries that are made and kept and redistributed by global banks like Credit Suisse. Credit Suisse and the Swiss banks in particular, when there used to be three major ones, now there's only one apparently, they are heavily involved in moving money, all not real money, again, book entry money all over the world because of how Switzerland was a major historical banking center, tied very closely into the development and fabric of the Eurodollar system itself, going back to the early days. It's a central nexus, a central node in the Eurodollar network, which means the Swiss banks are redistributing US dollars far and wide throughout the world, throughout the global economy. Credit Suisse was no different. In their quarterly statements, Credit Suisse shows, among other things, I mean, you look at the asset side of their balance sheet, they've got a lot of loans, they've got some trading securities, but almost a little over 10% of their assets are in the form of what they call central bank funds sold, securities purchased under resale agreements, and securities borrowing transactions. Essentially, repo and certain other derivative funding transactions. Central bank funds sold, cash sold, securities purchased under resale agreement, that's repo, except it's repo from the opposite perspective. Repurchase agreements, or repo, is essentially borrowing cash on a collateralized basis. You're selling a security that you own or you have the ability to sell today and then buying it back or repurchasing it tomorrow. Essentially getting cash today, giving you the security, then reversing everything tomorrow. So the resale is from the opposite perspective, where I'm selling you or buying the security from you today. It gets confusing. You're buying the security from them today, so I'm giving you the cash, taking the security, and then tomorrow we unwind the transaction by I'm going to sell it back to you tomorrow and get my cash back plus a little interest. So a huge chunk of Credit Suisse's business, its assets, not just lending to businesses in Switzerland or throughout Europe or Asia or Africa or anywhere else, but also in these short-term wholesale markets, redistributing these euro dollars through repo, collateralized transactions. How much? Well, you go back in the numbers, back at the end of the fourth quarter of 2021, back when everybody said the economy's doing really well. I mean, it's doing so well, it's overheated and inflationary. Credit Suisse showed 103.9 billion. 103.9 billion CHF, these are Swiss francs, that's a lot, even in Swiss francs, of these resale agreements. So essentially lending cash on collateral coming in and then doing some other stuff for the collateral that came in, which we don't need to get into today, maybe down the road. So 104 billion Swiss francs, that was fourth quarter of 2021. Second quarter of 2022, so the middle of last year, right when everything started to get a little bit haywire, still 104.2 billion in resales, so basically consistent with the end of fourth quarter, which you have to wonder why it wasn't increasing, because in an economy that's overheating, which if it was real inflation, we would expect more money to be introduced. So, that's just the one bank. Maybe it's just Credit Suisse. To the third quarter, so that's the end of September. Remember September of last year? Lots of stuff going on. Credit Suisse showed 107.7 billion Swiss francs in these resale agreements. So a little bit more at the end of the third quarter, at the end of the second quarter. But then, remember what happened. Into October, suddenly we've got these Swiss dollar auctions that I've I think you've heard me mention once or twice before since last October. We had a couple banks show up one week because they were weekly at the time, then more banks, and then for the third week in a row, we had almost $11 billion at the Swiss National Bank when normally nobody's there bidding anything at all. This was in October. Some people speculate, was that Credit Suisse? And obviously it wasn't, because you had over a dozen banks in Switzerland bidding for these dollar funds. But we know why. We have a really good idea why they were doing this. So we had 107.7 billion Swiss francs relent in resale agreements, so in lending cash into repo markets as of the end of September last year. Now, we don't have weekly or daily numbers from Credit Suisse or any of the banks, but as of their annual report, so the end of last year, what did Credit Suisse report in resales? 58.8 billion. That's almost half. So about half of what they were doing in the third quarter. And I will wager that a huge chunk of that reduction in resales coming from the Credit Suisse was in the first part of October. Because as I always say, when dealers get in trouble, remember this Eurodollar system is a global bank dealer-driven system. When dealers see problems, when they get themselves into problems, they pull back. They pull back from these wholesale markets like repo, not just in lending cash, but also in redistributing collateral. And here we see, from the end of the third quarter into the fourth quarter, as all this stuff was going on, the big stuff, and then the Swiss National Bank auction, dollar auctions in the early part of October, Credit Suisse, they weren't the ones at the Swiss National Bank auctions. They were the one who probably caused it, because they were not lending dollars into the wholesale markets, leaving a bunch of counterparties in Switzerland and around the world to scramble for alternatives, including the Swiss National Bank auction. That's a major, major reduction. And you have to wonder, because Credit Suisse, as many of the Swiss banks used to be, such heavy participants in the Eurodollar redistribution function, which is a huge part of elasticity in a global reserve currency, what is that going to look like now that it's merged with UBS? What does that look like over the last week? What did that look like with all the stuff going on and the March bottleneck? So Credit Suisse, repo, less cash being lent, less securities flowing through the business. Kind of looks like what we saw over the last 10 days or so. And so, of course, what does the Federal Reserve and all the other central banks do? They come in and say, we've got it covered with these dollar swaps that never actually have anything covered. Just like with the BTFP, more stuff that's happened after the major events, after the announcements, than before it or during it. These things don't work. Even if things look better today, and maybe they look better this week, the lessons of Bear Stearns are being learned all over the Eurodollar system. And not learned for the first time, but learned many times over, with Credit Suisse providing yet another example. And if Credit Suisse is pulling back on their dealer activities in repo and collateral, others may be doing the same thing, not to the same extent because they're not in the same boat, not yet, but they're all pulling back. And we can see this in any number of ways in real time, including, as I mentioned last week, 0% rates on T-bills. I'll give you another one, something that's happening today. Japanese government bond bills, which is a global Eurodollar collateral shortage, strains, run measure. 3-month Japanese government bond bills have been, we're at minus 28. That's about the same or a little bit less than last September and October. Seeing the same things happen because the Fed isn't central banks. These overseas dollar swaps don't work. The Fed tries to create elasticity and make the system function through psychological effects of this announcement function, when real dealers providing virtual currency through this massive book entry system, this world-spanning book entry system, are doing less and less and less. Are the money dealers globally going to be more willing to participate in resales and collateral securities lending after Credit Suisse? Or are they going to be, like after Bear Stearns, less willing to do the same things, which is going to create problems as dealers pull back, liquidity dries up, markets become less functionable, it all becomes this self-reinforcing downward spiral. So it's again, like Silicon Valley Bank, this isn't really about Credit Suisse. Credit Suisse is merely the weakest one, the first one we're seeing exposed to this systemic retreat. And all that is tied into the fact that most of these banks, most of these economists, most of these central bankers really thought 2021 was about inflation, but it never really was. I'm Jeff. This is Eurodollar University. Thank you very much for joining me. I do appreciate it. I really can't thank enough our Eurodollar University members, as well as all the research subscribers. Again, thank you very much from the bottom of my heart. And until next time, do take care.
Well, there it is. Let's check out Stephen Van Meters.
They're running out of dollars. I'm your host, Steve Van Meter, and thanks for joining me today. In our lead story today, global central bankers are panicking as they invoke crisis-era swap lines as they believe the world is running out of dollars. We're going to take a look and see if this will actually solve the liquidity crisis, and if not, why are central bankers even bothering to do this? We also have news that bondholders at a major international bank have been wiped out overnight. We're going to take a look at what happened there and why this will have major repercussions for the entire banking industry. Plus, small and mid-sized banks are begging the government for more help. We're going to take a look at what they're asking for and why they know that the worst for the banking industry is yet to come. And we've got one of Wall Street's most storied analysts is saying the end of the bear market may be coming soon. We're going to take a look at what his call is and why we think the worst is yet to come. Let's go to Bloomberg, where we picked today's story up with a headline: Fed and global central banks move to boost dollar funding as they're going to boost the frequency of their swap line operations, hoping in every bit of way that this will actually fix the problem. As central banks involved in the dollar swaps will increase the frequency of 7-day maturity operations from weekly to daily, and this across a coordinated statement with the Fed, Bank of Canada, Bank of New England, Bank of Japan, and ECB, and the Swiss National Bank. So what are these swap lines? What do they do? What's going on here? So what this is intended to do is, let's say that you have euros and you need dollars and you're having trouble getting someone to take your euros and swap you for dollars, and so there's a liquidity issue in the market, because normally there shouldn't be a problem swapping one currency for another in the marketplace. So what the central bankers are believing is, hey, there's a liquidity issue, or at least we perceive there's a liquidity issue. So if you're having trouble, you can bring your euros to, say, the Fed. We will then swap you for dollars, but it's a loan. You have to pay the loan back with dollars. And the idea is these are already available on a weekly basis. As the article said, these are open once every 7 days. Now the issue is, well, maybe people have a problem with liquidity on Monday, even though we may be running our availability on another day this week. So perhaps if we just have it every day, this will actually alleviate the issue, unless this isn't the issue at all. The U.S. Central Bank has typically provided access to such arrangements at times when there's a squeeze on the availability of dollars, and that can arise because banks outside the U.S. typically have obligations, or what are referred to as debts, that are denominated in greenbacks, and in times of financial strain have less access to dollar funding. And so this is exactly true. The question we should be asking is, why are we invoking crisis-era swap lines if there isn't actually a problem here? Because we know from the Bank of Japan, overnight, they said, hey, we did what we said we were going to do, and no one came. So no one needed money from us. So the question is this actually the problem, or is this just some response by the central bankers to hope and make sure that maybe the system will just work its way out, or is there some other issue we've got going on here? The liquidity injection is very much needed, especially for the Swiss and European central banks right now. We learned the hard way during the global financial crisis in 2008. Now we can stop right here and say, we're not in a financial crisis right now, or at least we don't look around. It certainly doesn't look like a financial crisis. Perhaps you could weigh in the comments, do you think we're there now, or is one just around the corner, or will they get it right this time? When it took too long to set them up, the Fed was much faster in March of 2020 and this time around. And this move comes amid heightened tension that began with the collapse of 3 U.S. lenders about a week ago. So was the issue, let's try to figure this out. Was the issue with those 3 regional banks that failed that they said, hey, you know what? We've got a whole bunch of euros or yen or other currency, and gosh, we really need dollars, and no one will swap it for us. Or we have a whole bunch of dollars, and the problem is our depositors, they want all these foreign currencies, and we can't get it. No, it wasn't any of that, wasn't that at all. So it's telling us that this dollar swap lines, all these swap lines are probably going to be rather ineffective here, as the boost of swap lines will enhance the provision of liquidity, or perhaps the impression of liquidity is really what they're trying to do, describing the arrangements as an important liquidity backstop to ease strains in global funding markets and mitigate the impact on the supply loans to households and businesses. So I think we can safely say that the reason they're doing this is because they have nothing else to do. So they're not sure what the problem is, because this doesn't appear to be fixing anything. So what they're doing is saying, look, we're just going to do everything. And then when it gets worked out, presuming it does, then of course you'll know the central bankers will raise their hands and say, hey, look, see, we fixed it. Good thing we're here. But in reality, as I've said before, there will be policy responses, and they will largely be ineffective because whatever's going on here is not what the central bankers think it is. But now let's turn to the banking system back again to our story on Credit Suisse, where we see bondholders now getting wiped out. And that's not the story. The story is why this is going to be a problem for the other banks. As Credit Suisse bond wipeout threatens $250 billion market, if you hadn't heard over the weekend, UBS has now entered an agreement to buy out the troubled bank, and this is what actually is now the fallout. AT1 bonds, also known as contingent convertible bonds or COCOs inside the industry, were introduced after the financial crisis, so you know, of course, it must be great, as a way to transfer banking risk away from taxpayers and onto bondholders. They also became a popular investment product that money managers and banks, including Credit Suisse, marketed clients to get this as a relatively safe way to boost yield on your bond portfolios. And European banks love to issue these AT1s, even though the interest costs are higher than traditional bonds, because their bail-in features reassure regulators that the banks hold enough capital buffer. And that makes AT1s a less financially painful way of building up capital than issuing common stock or equity shares. So I want you to understand is the first thing is banks are using this in an alternate way instead of issuing shares to raise capital. So it seems like a pretty good idea. Well, until we find out this is what just happened to all the Credit Suisse AT1 bondholders. Under the terms of the deal between the 2 Swiss banks, the AT1 holders get nothing, while equity holders get UBS shares that are not probably worth a whole lot comparatively. The value Credit Suisse's existing shares at around 0.7 Swiss francs. That is far below where they traded Friday, but still something. So what we're facing here is the real issue is there's a ton of these out there, which we'll look at in a moment. But I want you to think about this. If a bank needs capital right now and they cannot go out to the equity market because no one wants to buy their shares, so they say, hey, you know what? I'll issue some of these AT1s. But now guess what? The market's starting to find out that, hey, maybe those things that I thought were relatively low risk mean I could lose everything. And this is going to put bank funding into a bigger issue of stress. There are about 254 billion AT1 bonds outstanding. Imagine if those went bust, and the securities are often banks' most actively traded bonds because of their large size. They also pay a higher interest rate than traditional debt because it can be converted to stock or written down, in this case, all the way to zero if trouble at an institution emerges. So that is actually a problem because now, again, as I said, all this is going to do is put the question now if they're going to get wiped out. And I'm not saying that they shouldn't. Do not interpret it as me saying that, you know, that they should get wiped out so the other banks have some leeway to raise capital. I totally agree. Maybe you disagree with me. You can weigh in the comments. I have no problem with them being wiped out. I just want you to understand there's going to be repercussions here to the broad industry. Is if people think they can lose everything and the banks raise their hand and say, hey, we need some money, buy some of these bonds, people might say, you know what? I don't think so. And now let's turn to First Republic, because there's more problems here in the small and mid-sized banks that are telling us that all these things the central banks are doing, the government's doing, aren't working. As First Republic stock continues tanking, but other regional banks, at least for the moment, were rallying on early Monday. First Republic continued to crash at the time of recording. As the S&P reduced its credit rating for First Republic to B+ from double B+ on Sunday after first lowering it to junk status just last week. And of course, that was enough to get everybody to flee. But let's dig deeper here, because what we're trying to see here at First Republic is a big hole that's trying to be filled, and perhaps there just isn't enough money to fill it, or there's fear that this hole is going to get a whole lot bigger and no one has the power to stop it. On Thursday, a group of major banks, as we talked about last week, agreed to deposit $30 billion in First Republic to shore up confidence, which obviously so far hasn't worked, even though it suspended its dividend, says it has $34 billion in cash. The deposit infusion from 11 U.S. banks. The company's disclosure that borrowings from the Fed, get this, range from $20 to $109 billion, and borrowing from the Federal Home Loan Bank increased by $10 billion, and the suspension of its dividend collectively led us to the view that the bank was likely under high liquidity stress, as S&P noted. What a shocking concept here, but believe me, the reason their stock price is still crashing is because people believe that this liquidity injection, these loans, are not enough to fix the problem, and that's why we head over to this story to see why the small and mid-sized banks are begging the government for help. There's a good reason why, because they know this is going to get a whole lot worse. As mid-sized U.S. banks ask FDIC to insure deposits for 2 years, wait a second, what's going on here now? Notwithstanding the overall health and safety of the banking industry, confidence has been eroded in all but the largest banks, which is true. Confidence in our banking system as a whole must be immediately restored, adding that the deposit flight would accelerate should another bank fail, which is literally stating the obvious here. If we continue to see banks fail, and if you're not looking at where your money's at, I can promise you a lot of other people are thinking about how much money they have at these various banks and are reevaluating whether they should keep it there or move it out, because there is real fear here. And if we do see another bank fail, well, they're right. Money is going to flow out in a huge way, as they cited remarks by Treasury Secretary Janet Yellen that the backstops put in place so far will protect uninsured deposits only. Get this, only if regulators find it necessary to protect the financial system, and it's a category unlikely to include the smaller banks, and that's what has them afraid right now, is that they could run into problems as deposit flight continues. The government says, hey, you know what, we're only going to cover up to the FDIC limit. Unlike the other banks, which we thought were more important, we don't think you are. And as long as consumers and depositors think their money isn't safe, they will move it, and that will only make the problem worse. But one person who thinks that this may be getting close to the end, that's Mike Wilson, and he says that we could be near the end of the bear market. As Morgan Stanley strategist says, bank stress signals, bear market end, I think I'm going to have to disagree with him, even though he's one of the most accurate analysts on the market today. With backstopping of bank deposits by the Fed and FDIC, many equity investors are asking if this is another form of QE. It's not, who correctly predicted the sell-off in stocks last year and rebound in October. We argue it's not, instead represents the beginning of the end of the bear market, as falling credit availability squeezes growth out of the economy. Now remember, a lot of people believe that the stock market reacts to QE in a positive way, QT, which is what we're doing right now, in a negative way. So they're trying to reassess and say, hey, is the Fed doing QE here? Because there's this mythical belief that somehow QE causes stock prices to rise, when it really has absolutely no relationship. Wilson is not alone in forecasting a tough time ahead for the markets. He said the inverted yield curve will be proven right, signaling recession ahead. We're going to challenge that here in a moment. The first quarter will likely be the high point for stocks this year, and that equities won't reach lows until the Fed has pivoted to cut rates. Well, I obviously disagree with. Here we can see the 10-year, 2-year yield curve in red against the Wilshire 5000 price index in blue. The green line is the baseline of where the yield curve is inverted. And what's important to note is when the red line is crossing positive up through the green line and rising, you can see that happening 1, 2, 3, almost 4 here, very close, and not yet 5. Notice what happens to the blue line as the yield curve steepens. the stock market in blue sells off. So the idea that when we look up here in the corner and say, hey, maybe the bear market is over, maybe, I don't know if you agree with this, maybe the bear market hasn't begun yet. So I'll let you weigh on that in the comments. Let's look about the federal funds rate here, because the notion that the Fed cuts rate and everything's okay, here you can see again the Fed funds rate now shown in red against the Wilshire 5000. As the funds rate declines, you can see that each time here, what happens to the blue line, the stock market, you've got it heads lower. The market doesn't bottom until it believes the Fed actually has control over what's going on, or the market has actually kind of settled into the recession, being near the bottom. We're nowhere close to that yet, but Mike Wilson saying we could be there. Well, I don't know about you. I'm going to say I disagree. I think this whole problem is going to get much worse. What the real issue underneath the system is, I don't know. What I do know is the central bankers are powerless to stop it. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.
So is it the fact that Twitter, don't let it dominate people's lives? Is that the problem with the tweet?
I didn't, at that point in time, I did not understand fully. I was relatively new at Twitter, and I was trying to understand what the policy was, and therefore
I just want to ask you, the other two were asked, where did you go to medical school?
I beg your pardon?
Where did you go to medical school?
I did not.
Well, I'm going to call it a night, but it's a little bit of what's going on in the world.